Lions and tigers and crypto taxation. Oh my, this is the Issues Watch podcast. Hello and welcome to the Issues Watch podcast. My name is Nicole DeRosa, Senior Tax Manager at Wiss & Company, and I am very excited to be your host for the tax episodes. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this and other episodes, stop right here, hit the pause button, and now head over to njcpa.org/nano to find out more. A quick disclaimer, the views and statements expressed herein are mine own and not necessarily those of the NJCPA or Wiss & Company. Tax season is upon us, and one of the hottest tax topics this year, aside from the advanced child tax credit, of course, is reporting cryptocurrency transactions. Lucky for us, we have Dr. Sean Smith here with us today to give us some insight on the crypto crackdown so that we can all walk away with a better understanding of the different types of transactions and how to report them on a tax return. Sean is likely not a stranger to many of you, as he is an NJCPA member who speaks regularly on all things crypto and also hosts monthly Issues Watch podcast himself. If you haven't done so already, go and check them out. I'm also excited that Sean and I will be serving on the NJCPA Board of Trustees together beginning in June. Welcome, Sean.
Awesome, Nicole. Thank you so much for having me here on the NJCPA Issues Watch podcast. And so I'm going to dive right in today because there's a ton to talk about, tons of update, and I only have 8.5 minutes to do so. So off the top, right, tax update on crypto. So hopefully at this point, everybody tuning in here today knows that overall crypto transactions are taxable, right? That as per the IRS, all crypto assets are treated as property. So any mining, staking, earning of other coins and tokens, trades, swaps of anything, coin for coin, paying for items in crypto, being paid for goods and services in crypto, or any transactions, transfers, transformations of a coin or token into any other coin or token is 100% taxable. Now, off the top here, that's the obvious part. Now, it's not quite as cut and dry as that is, though, but off the top, during any ongoing conversations, either now or in the future, either internally or externally, right? That's the baseline to try to get the ball rolling. That any transactions, be mining, staking, DeFi, NFTs, I'll come back to those, don't worry. Any transaction involving coins or tokens or assets linked to a underlying blockchain are going to be taxable. And the ordinary income versus any cap gain treatment, all of that is also driven by the whole period, right? Under 12 months, ordinary income; over 12 months, cap gain, normally. But it isn't quite that straightforward, right? Because I just went through and said everything's taxable, right? But it isn't quite that straightforward because all of our conversation, I've been talking on this topic probably since about 2016. And so all of this is actually based on IRS rulings, FAQs, and commentary, right? Hearings, conversations, court cases, but it isn't actually based yet on any changes to the IRS tax code, because obviously tax code is tax law, and laws have to be passed by the Congress, who are too busy right now arguing with each other to do anything productive. But all of that is a whole other issue. And so actually taking a big step back here, right? If we classify all crypto as property, then technically there is no taxation owed until the property is actually sold. Okay, fine. But for any trading, buying, selling, that's all straightforward stuff, has not changed. Here's where it's a bit more complicated, right? That if you have an external client who's involved in DeFi, any sort of pooling activities, or any staking activities, basically earning crypto as a result of allocating funds to a firm like a BlockFi, Celsius, Coinbase, or any of the other platforms out there, is that technically taxable, right? And a good anecdote is, if you had an external client who is a farmer growing apples or mangoes, although probably aren't growing mangoes here in Jersey, but anyway, right? If you had a client who is actually growing fruit, is that fruit taxable after it's picked or after it's actually sold? It's only taxable after it's sold. So if apples and crypto are both property, right, treated as property, right? If they're both treated as property, is there any tax owed on any of these other new iterations, any staking, royalties paid out in crypto, or any earnings that are being accrued but aren't able to be accessed yet until they're sold? The answer is we aren't quite sure yet, but a key takeaway here is to be sure to ask your clients and to ask and ask and ask, right? Like this personally, I know during the month of January, I've gotten at least 25 calls from individuals who were engaged in trading DeFi, NFT, non-fungible token activities during this past year, who now are going to owe taxes, who had no idea how they were even involved in crypto. So it's really, really easy to be involved almost on accident in any of these transactions, any of these activities in this DeFi space, NFTs, more of these advanced, on the one hand, applications, but on the other hand, it's easy to be involved. Robinhood, Coinbase are all apps on our phones. And so it's really, really easy to have crypto taxes almost on accident. But so all of that is a whole other conversation for a whole other in-depth, and I am going to be talking about that in an upcoming event. So don't you worry. But in terms of any trading activities, listen, any trading activities are going to incur at the very least a tax filing obligation and probably a tax payment obligation. And all of us have to now check or not check that box on the first page of that 1040 every single year. So ask and ask and ask. And as far as any charitable contributions go, again, as the IRS treats crypto as a property, or as property, sorry, those guidelines and rules are the exact same thing. Hasn't changed. Finally, something easy, right? Okay, now policy talk, right? Which I know everybody loves, right? Talking policy, governmental stuff, right? It's always fun. FinCEN is kind of back in the pool, right? Just over this past weekend, January, end of January, right? FinCEN basically reopened the whole conversation on the unhosted wallet conversation. I won't dive into that too much, but off the top, I would guarantee, I don't guarantee many things, but I would guarantee that probably starting in 23 and definitely 2024, there is going to be more compliance, more documentation, and more tax reporting that has to be done, right? And right now they are arguing on who has to do it, who is a broker, what's the dollar cutoff as to who has to do what. But overall, there's definitely going to be more compliance coming down the pike. So again, it's really, really critical to be proactive now, to have those conversations with your clients and to help them understand what they know and any unknowns out there going forward. But there is some upside that, again, because crypto is actually classified as property, wash-sale rules don't apply. And so if you have clients who have losses so far in 2022, it can come in handy for some of that tax loss harvesting. Just a quick upside there, just FYI. And so ultimately, who is a broker, right? And here's a question that is ultimately going to drive a lot of the tax compliance and tax payment conversation going forward, and it has no answer yet. But here is the crux of it. If the current law is being argued about right now pass as they are currently written, basically anybody who's involved in any type of transaction linked to crypto, miner, staker, trader, developer, coder, anybody who's involved could be classified as a broker. And so as the IRS and the Treasury and FinCEN try to figure out how to write and then how to enforce this law, it could actually basically involve anybody who's involved at any level in any crypto activity. But it's important to note that if the law goes into effect as written on January 1st, 2024, and a individual or institution is not in compliance, it's a felony. So to end on a sort of ominous note here, right? There are some current changes due to NFTs and DeFi, all the rest, but there are some big changes that are possibly coming. But either way, right? The core items here Be proactive, ask questions, document going forward. And so in a quick 10-minute update, that's our NJCPA Issues Watch tax update. Handing it back to you.
Thank you so much, Sean. And thank you for all watching. If you liked what you heard from Sean today, you can catch him at 2 upcoming NJCPA webinars. He has a lot of great stuff to talk about. On March 2nd, he will be presenting a crypto tax overview and regulatory update. And on March 30th, he will be taking a deeper dive into crypto tax as they relate to decentralized finance, stablecoins, and non-fungible tokens, NFTs. Go to njcpa.org/events for more information on these and other events. Also, I recommend that you join the NJCPA federal taxation and/or state taxation interest groups by going to njcpa.org/groups. Thanks for joining us today. We'll be back with a new tax episode soon. You can access all Issues Watch podcasts on njcpa.org/podcast. Take care, everyone.